Today I will read the article about interest rates. The first topic is interest rates and monetary policy. An interest rate is the cost of borrowing money, the percentage of the amount of a loan paid by the borrower to the lender for the use of lender's money. A country's minimum interest rate, the lowest rate that any lender can charge, is usually set by the central bank as part of monetary policy designed to keep inflation low. This can be achieved if the amount for goods and services and the money which to buy them is nearly the same as supply. The amount is how much people consume and business invest in factories, machinery, creating new jobs, and so on. Supply is the creation of goods and services using labor, paid work, and capital. When interest rates fall, people borrow more and spend rather than save, and companies invest more. Consequently, the level of the amount rises. When interest rates rise so that borrowing becomes more expensive, individuals tend to save more and consume less. Companies also invest less, so the amount is reduced. If interest rates are set too low, the demand for goods and services grows faster than the market's ability to supply them. This causes price to rise so that inflation occurs. If interest rates are set too high, it lowers borrowing and spending. This brings down inflation, but also reduces output, the amount of goods produced and services performed, and the employment, the number of jobs in the country. The next topic is about different interest rates. The discount rate is the rate that the central bank set to lend short-term funds to commercial banks. When this rate changes, the commercial banks change their own base rates. The rates they change their most reliable customers like large corporations. This is the rate from which they calculate all their other deposit and lending rates for savers and borrowers. Banks make their profits from the difference, known as the margin or spread, between the interest rates they charge borrowers and the rates they pay to depositors. The rate that borrowers pay depends on their credit worthiness, as known as credit standing or credit rating. This is the lender's estimation of a borrower's present and future solvency, their ability to pay debts. The higher the borrower's solvency, the lower the interest rate they pay. Borrowers can usually get a lower interest rate if the loan is granted by securities or other collateral. For example, mortgages for which a house or apartment is collateral are usually cheaper than ordinary bank loans or overdrafts. Arrangements to borrow by spending more than is in your bank account. Long-term loans, such as mortgages, often have floating or variable interest rates that change according to the supply and demand for money.